Hello and welcome to Gold and Silver Assets. It's Sunday, the 20th of September 2020. Today we're going to cover what sounds like a popular topic, judging by the viewers' questions that we've had, and that's the topic of ETFs or exchange traded funds. Are they a trap? Physical gold. You know what it is. You just look at it and you can hold it in your hand and you have direct ownership of it. It's pretty straightforward. An ETF, on the other hand, involves a contract. Here shown is part of the first page of the GLD ETF prospectus. The whole thing is actually 36 pages of fine print and clauses. We can immediately see that there's a big difference between ETFs and physical gold. But let's look at this more closely. Why would someone own an ETF? Well, they do have their advantages. They offer great convenience because you can trade them quickly and easily from the comfort of your own home with just a click of a mouse. They are very liquid, and back in March, when physical silver was tough to get hold of, you could still buy the SLV shares. You can leverage your trade through options on ETFs, and so that basically provides leverage, which is very difficult to get if you're buying physical gold. You're not paying the premiums over spot that you would pay when you buy physical gold. But remember that depending on the platform you use, you will still be paying a trading fee. You're not paying storage fees, but there is a management fee. It's just under 0.5% per annum. That all sounds pretty good so far, but there are a few things that should be considered when buying an ETF. One of the common misconceptions is that people often think that they can redeem their shares for physical gold or silver, and this is strictly not true. If we look at the fine print for the GLD prospectus, it actually says that the shares are neither interests in nor obligations of the sponsor, the trustee, or the marketing agent, and may only be redeemed by or through an authorised participant and only in baskets. And by the way, a basket is 100,000 GLD shares. And let's face it, you as a retailer are not an authorised participant. Also, even if you were an authorised participant, you could be refused delivery and settled in cash instead. So no, it's not a substitute for physical gold because you can't really redeem it in physical gold. You can only redeem it as cash. The biggest and most liquid ETFs for precious metals are usually listed on the American exchanges and so are denominated in US dollars. The equivalents on exchanges in other countries that are denominated in other currencies don't really tend to have the same level of liquidity. And most of our viewers do live outside the USA and may be considering buying US dollar denominated precious metals ETFs. One of the issues with that is that as well as being exposed to the gold or silver price, you're also adding currency risk to your trade. Let's say, for example, you're in the UK and you exchange British pounds for US dollars and then buy a US denominated gold ETF. Your life and expenses are in British pounds, and so when you come to cash in, then when you sell the ETF, you'll get US dollars, but then you have to convert it into pounds. If the US dollar gets stronger, then you'll benefit, but if it's weaker, then that's going to reduce any gains that you get from the exposure to the gold price. And so it's adding an extra layer of risk. If you've got physical gold, on the other hand, it's basically universal. There are ways of selling physical gold for your currency of choice. There are also important tax implications, and this will differ by country. Some might have capital gains tax on ETFs but not on physical gold, whereas other countries might have wealth taxes on physical gold but not on metals ETFs. And that's something you'd need to look into on an individual basis. Of course, everything has risks, and ETFs are no exception. One risk is that ETFs are a paper proxy for metals and are effectively fiat currency with exposure to the metals prices. And that's very, very different from holding the physical metal itself. A big issue is that you have counterparty risk. Well, who are these counterparties? Firstly, you have the trustees, which for the GLD is the SPDR Gold Trust. Then you have the custodian who sources and arranges storage for the gold. In the case of GLD, that's HSBC. That means that your investment is part of the banking system. Then you have sub-custodians, which might be other banks or even central banks. And the thing to note here is that there are no written contracts between these three entities, and so any legal action between them is going to be limited. Overall, you have at least three counterparties, and if something goes wrong, who are you going to call? I don't think any lawyers are going to be able to help you, and certainly Ghostbusters won't be able to help you. You might say, well, isn't all of this covered by insurance? Well, it's not insured by the trustee, and I'm not sure about the level of coverage by the custodian, but I'm pretty sure it's likely to be of minimal benefit to you. Another common misconception is that each share of the ETF is backed by physical gold. Well, it isn't. Some of it is likely to be backed by leased gold, which is far from ideal. Preferably you want it backed by allocated and even better segregated gold. This is something that's really important to look for when you're investigating the different metals ETFs options that are available to you. I'm pretty sure the GLD and SLV ETFs use a significant amount of leased gold. I've also heard that the Perth Mint ETF may also be using gold leased from the Australian central banks, and that's something that someone called John Adams has covered recently in Australia. The Sprott ETFs do say that their metals are fully allocated, and I'm inclined to believe them since they do have the contacts to be able to source those metals from the miners. If something happens that makes the spot price decouple significantly from the physical price, then owning the ETF would be a disadvantage compared to owning physical gold. And of course, it's entirely possible that the ETF could go bankrupt and your investment could go to zero. So for example, if something happened to HSBC, then the GLD ETF may well hit some trouble. The only way that physical gold would be valued at zero would be if there were no humans left on the planet. I'm not going to bash ETFs too much, as there are some valid reasons for owning precious metals ETFs. It might be that you don't actually have a choice. So for example, some retirement funds don't offer physical gold options, but they might allow ETFs, and so that would allow you to have some exposure to the gold price. In that case, then it's going to be up to you to look through all the different ETF options and select the best one that you can, and just have to accept, that there are pitfalls with these things. ETFs are much better than physical gold if you are working on short timescales. So we're talking about the order of days, weeks, or a few months. And this is because by using the ETFs, you're avoiding having to pay the premiums and storage fees. They're also useful if you want leverage, as we've mentioned before, and they can be useful if you want to hedge your physical position. Overall, ETFs are not a trap so long as you know exactly what it is that you're getting into and why. And that does mean going through the prospectus and being clear about what your expectations are. If your aim is to invest outside of the banking system, then ETFs aren't for you, for example. Let's face it though, looking at these contracts, they're never drawn up to benefit you, and they include multiple pages of indecipherable lawyers' language. With physical gold here, you don't have such a contract. It does exactly what it says on the bottle. Next up, the market update. Let's start by talking about the US dollar. So this is a monthly chart of the DXY. Now I did post this draw on the community tab a couple of weeks ago because we did have a request about that. And so in that post I had spoken about how this lower upsloping trend line was an important point here, and the dollar had just about hit that point there. And my assessment was that we would bounce off of that line, which we have. So just remember this is on the monthly scale, and I'm going to zoom in on this area over here. So this is the same chart but on the daily scale, and this is the area that I had circled, and this line here is that big upsloping trend line. And the interesting thing was that price did just poke down below it, but went straight back up and never closed below it. So that was just a kind of feeling through that support line there. And of course price bounced off of it. And what we've got is an interesting pattern here, and I've drawn the lines to join the highs and the lows over here. So this is a descending broadening wedge. So what we've got is prices kind of bouncing up and down between those. And we are close to what should be a breakout point, and I am thinking that this is going to break out upwards. What we've had is that this top trend line has been tested a few times now, and this is a retracement. It actually reached 50% retracement of this rise up here, and I think we're going to probably turn around here, and if we get above this point, which is around 93.60, then I think we're going to move upwards from there. What's the upper target? Well, hard to say. We would have to kind of look at resistance points above. So one would be around here at 96, but I think it's quite possible it could go up to this line here, which was the center of that draw in the last chart. So, you know, all of this is quite possible, but from what I can see, this is quite a strong support line for now. Obviously, after we've had this bounce up, then we could well come down, and any break of that lower support is going to be very, very significant. And the reason I'm discussing this is because it does have a bearing on what happens to the precious metals, as well as the stock market and the miners. Let's move on to gold priced in US dollars on the daily scale. And again, another ho-hum week, really. Not very much has happened. Now, we've drawn this trend line, and actually last week someone pointed out that actually it starts further back, so I've actually just extended this line backwards, but it's the same trend line. And this structure here has been quite puzzling and possibly frustrating if you've been trying to trade it. It hasn't really broken out from whatever triangle you're thinking it is, and that's the thing with this, is that it can be interpreted in multiple ways. The first thing I would say is that this big trend line has broken. And I think that is a significant thing to remember here. And not only did it break, but it's been retesting it multiple times, but it's never really been able to close significantly above that line. So those two things, I think, make me think of weakness. What could this structure be? Well, we've spoken about symmetrical triangles, but the problem there is knowing where this is. Of course, if the top line is from here, then it's actually broken out upwards, but it just doesn't look like it's broken out. The other possibility is that you ignore this peak here and you start from here, and that seems to be a little bit more suitable, so you can join those highs there. And this could be a descending triangle, which is something that one of our viewers had pointed out last week, and that certainly does look plausible as well. If it is a descending triangle, then I would expect this price to move down to here, and it depends where it goes from there. I think any break below 1900, that makes me think it's going down pretty rapidly here, down to this area over here. And again, the target would be the height of this triangle, which again would fit with that target that we're looking at there. And of course, if the US dollar does rise, that again would fit in with this scenario that we're looking at here. Looking at silver priced in US dollars on the daily scale, again, we're just really within this trading range going sideways. But again, to me, this kind of is feeling a little bit weak. Obviously, you know, look, there's no guarantees with these things. It could completely surprise everyone and turn around and just shoot up. And, you know, remember, we are in a bull market, so you've got to be aware of those things. But again, based on what we've seen in both the US dollar and what our assessment is for gold, this again looks like it might dip below here, this support level here, which is around $26. Any break below $26, then I think we're going down. Now, of course, the low point is getting higher and higher as time goes by. So now we're getting into the $22.50 kind of area, possibly even 23. And remember, I don't expect price to stay in this region for long. Both for this and for gold, I would expect it to turn around, and then the next move up is going to be potentially quite large. Then we'll look at the GDX, and again, it's not very much happening. We seem to be in a sideways kind of trading range here. Hard to make out any kind of specific pattern. It could be a very shallow kind of triangle over here, but yeah, not much going on there. We have broken out from this long-term uptrend here, and so it's just a matter of waiting to see where it goes. But if the dollar does shoot up, then I'm expecting this to come down, and if it breaks this low over here, which is probably about 38 level, then if we use the height of this structure as the target, then we're looking at around 32 as the drop level. And in the monthly videos that we look at, where we look at the charts on the monthly scale, you'll know that anything that's at or below this level I consider would be a bargain. And finally, we'll look at the SILJ, and again, now this one didn't actually break out from its long-term uptrend here. It's just kind of hugging that level, and price is squeezing, and we're actually getting pretty close to a breakout over here. You can see that quite nicely there. We do have a bit of these pesky wicks going on down here, and that's what makes it really difficult to set a fixed price at where we think a breakout's going to occur. And so I'm using this longer term trend line as a kind of guide. But again, this is just, to me, it's looking a little bit on the weak side, And if we get a drop, we would use the height of this triangle as a guide to where we would go. Looks like we've got quite reasonable support here at 12, so it could go there. And last week we had some very interesting comments about the jewellery discussion. We had someone who was talking about pure gold buttons, which I'd never actually heard of, and I thought that was quite cool. We've got some stylish people in our audience, and we even had someone who was able to use their own gold that they'd melted down to make rings, which I thought was pretty amazing. Anyway, I'd love to see what molten gold looks like. So hopefully once the borders open, we'll be able to travel. And I know that in the Perth Mint, they actually have live gold pools. So I'm hoping to be able to go and visit that soon, hopefully. Anyway, all the best, and we'll see you next week. Bye.